one of the biggest misconceptions I see is that people think a mortgage is just about like getting approved for a loan and then that's really it. Like in reality, it's about finding the right loan that fits your financial picture, and not all mortgages are the same.
Hello, everyone. This is John Lee, your local real estate agent in the Philadelphia, greater Philadelphia area. I am here with my buddy Taylor Runyen from Philadelphia Mortgage Advisors. Taylor, if you can introduce yourself and a little bit about who you are and what your story is.
Yeah, John, thanks again, man, for having me on. It's a pleasure to be a guest on your show. I'm excited to kind of be here and chat a little bit. But yeah, absolutely. My name is Taylor Runyon. I've been in the mortgage industry for a little shy of 10 years now. Next month will actually be 10 years, believe it or not. So
Jeez, okay.
yeah, so I kind of more or less stumbled into this industry as my first and only job that I've had after college. And I wasn't really expecting what came after, but over time, I kind of realized that the ability to, help people obtain like the tangible goal of homeownership, that's like a key performance indicator, something very, very real that you can kind of demonstrate as success. To me, that was powerful and rewarding. So, then of course, along the way, I discovered, a passion for helping people understand their financial options, making sure they feel or have felt confident in their decisions for not only like the immediate, but 1 to 3 to 10 years after the fact or after I'm done working with them. Right. So I started doing what's called consumer direct mortgages, which is where through ads and SEO, I was helping people all over the country, primarily focused on the East Coast, get mortgages.
Mm-hmm.
And about 5 years ago during COVID, I decided to transition to like a more localized approach, specifically in the Philadelphia, Jersey, Delaware area. So I'm still licensed to help people with mortgages up and down the East Coast, but it was a little more, I think, rewarding for me to be able to help somebody in my backyard, so to speak. So I could meet them at settlement and then continue to be friends and a resource for them afterwards. So that's really kind of my background a little bit, or how we got here today.
Yeah, that's awesome, man. So for our listeners also, I know the interaction of how we met, but can you
Yeah.
share how that worked out?
Well, yeah, I mean, I guess maybe, it's probably a few years ago that you and I met. We go to or belong to the same church. And kind of through happenstance, I guess one day we just had a conversation without even really knowing what each other did, right? We were just talking one day and it was like, oh, you do real estate, John? I do mortgages. And then we just kind of, that was a few years ago. So it's just been a few years of kind of building that relationship. You and your wife, Jen, were at my wife, Laura and I's wedding last
Yeah.
year. So it's been kind of a good relationship. And honestly, hopefully you feel this way too, but at least for me, it's been good to have your guidance and just kind of somebody that I can lean on. And when things are good or bad, it's just been, I think, kind of a mutually beneficial relationship with both of us working together on kind of opposite sides of the coin.
No, that's awesome. But I think what you forgot to share was that you're a hell of a baseball player, right? So you're a hell of a baseball player and you're being humble right now. So you play college ball, right?
Yeah, well, we have we have some softball war stories for sure
Yeah,
together.
yeah.
Yeah, yeah.
So this dude is an amazing ball player and he is very athletic. And he's also very charming. So, but anyway, Taylor, my experiences with you were so great. In a sense where we obviously met and we talked about real estate, but I think, obviously, apart from me actually you hitting the baseball and like watching you play, I was like, damn, this guy's really good, right? I think that was like kind of like my I was in awe, right? I was like, damn, this guy's really good. So it kind of evoked me to get to know you a little bit more, right? And as I was peeling that onion, I was like, man, this guy's actually a really good dude. I got to get him on this show. So here we are, man. Introducing yourself obviously as a mortgage advisor, and you mentioned to us that you started and you obviously are still working in this field in this industry. Like, what has changed? Since from the time that you started to now, like, give us a brief idea of what has changed in your life and what has also changed in the industry itself.
Well, that's a big question. And thank you for the kind words about my baseball skills. You might be boosting me up a little bit, but as I
I,
mentioned,
I don't know, but yeah, you're good, man.
Um, as I mentioned just now, I started in like the online real estate world, which was like very kind of different. I was working closely with people in different capacities, like managing other salespeople and handling some other things involved with working in that online real estate space, like budgeting for advertising spend and whatnot. So after kind of doing that for a while, I did find a bit of a niche in just being more of like a localized and accessible professional. And yeah, thankfully became a vice president, senior mortgage advisor a few years ago. So working every day to kind of exceed that title. But I think as far as what's changed in the industry, it's a lot. It's a really, really different industry and dynamic now than it was even 5 years ago. One of the major ones, at least in my world, one of the biggest differences that I deal with every single day, is that interest rates for mortgages are not what they were 5 years ago. We're in like a super different dynamic. When I came into like that retail localized, mortgage space, people ask me every day, will we ever see rates at like 3% again, like they
Mhm.
were during 2020 and 2021? And I think that was just the perfect storm of like some macroeconomic level conditions like low unemployment, low inflation, and obviously lower interest rates being needed to stimulate the economy during COVID. So no, I don't think we'll ever get there again. And that's one of the biggest shifts that I deal with every day.
Right, right.
So there's a bigger shift in our industry, and maybe this is getting a little too into the weeds here, but there's a bigger shift towards more flexible loan options, whether it be adjustable rate mortgages, more kind of hybrid solutions like a 5 or 7 year adjustable mortgage where the rate is fixed for the first few years and then it adjusts after that. I'm seeing a drive towards way more first-time home buying programs that didn't exist when I started 5 years ago.
Right.
So I think there's kind of a culmination of different macro level things that are impacting our personal day to day. And then we just kind of combat that as an industry to help more people, ideally.
Yeah, so I know that what makes you really competitive are obviously your products, but I think what really gets you quote unquote sold, especially with the community of buyers that I've been referring you, is just you as a person, right? You just being a genuine person. But I think also that's a testament to your company, right? And what you offer, like what are some qualities and features and even products in some cases that really help you stand out versus others?
Yeah, really good question. And like I said a few minutes ago, I've been at Philadelphia Mortgage Advisors my entire career. So like that rarely happens nowadays where like you leave college, you graduate, you get a job, and then you stay at that company for 10 years. It doesn't really happen too often. So I think our major, like a number one differentiator as a company and why I've aligned myself to Philadelphia Mortgage Advisors professionally is just our approach to service, which sounds really, really basic. But just kind of to get down to it, a lot of mortgage companies offer the same interest rates, more or less. So what really matters, and I think matters to home buyers, is like the other details behind just the interest rate. So our company is a direct lender. We're not a mortgage broker, which is so huge. That means that we actually underwrite your loan in our office, and then we fund your loan when you go to closing with our own money instead of relying on someone else or some other company to do those things.
We
So
can
not
I can
only,
I pause
yeah,
there for a second? So what does that
yeah.
mean to a potential buyer though if that loan is being brokered out? So what does that like what does that mean
Mhm.
in a sense of like if you can rephrase it in simple terms, but also what does that mean in a sense for them financially and like other aspects for a
Yeah,
potential buyer?
good question. I think number one is accessibility, right? So if you're dealing with a broker mortgage company, a company that's not doing your mortgage, when you go to order your appraisal or just kind of get updates on where things are. Hey, John or Taylor, like, can I have an idea where my mortgage is at? they're not the ones in control of that. So they really don't know. It's more or less dealing with like an 800 number, like when you ever have to call customer service, like you're just kind of going out to like some big umbrella to kind of figure out what's going on. Whereas like you text me. It doesn't matter if it's 8 p.m. on a Friday night, you can text me and I'll get right back to you. So that's huge. When you're buying a house, there's so many things going on. Just that accessibility is massive. But I think in addition to that, being a direct lender, as far as like other logistical things, it helps with speed, consistency. I honestly think we have lower terms just because we work with so many different investors instead of like, not to single anybody out, but Wells Fargo only has Wells Fargo Mortgage. We have Wells Fargo Mortgage and then 10 other banks that we work with. So we can really figure out where like the best terms are for you.
Mm.
But I've had different, like to be honest, I've had different job offers throughout my career, but have stayed put just because of the really, really strong team I have behind me, the flexibility I'm offer when it comes to getting my borrowers or clients the best programs, terms, rates, efficiency. It's all really the reason why I've aligned myself in one place and have not even considered leaving for 10 years. So I think that's our competitive advantage. It's just all those things in a nutshell.
Right, right. And to change gears a bit, I think
Yeah.
you mentioned this before, like the landscape of rates have changed significantly, and I'm sure you've had a ton of buyers that come in and asking, what are our expectations, right? You also mentioned some creative ways to finance deals, whether they're, like different products like arms and stuff like that, right? So, with where rates are right now, I mean, obviously we don't have a crystal ball. I don't have a crystal ball. You don't have a crystal ball. But like,
We
what are
got a
your like
yacht
based
right
on
now
your
for you.
math?
Yeah.
Yeah, based on your math, like, what are you seeing? Like, what are you hearing? What are you seeing on your side of it?
Yeah. I mean, it's another great question. Like you said, if we don't have a crystal ball, if we did, you and I would be probably sitting on the Mediterranean right now, just enjoying our yacht. But, I think the higher environment rate can be a challenge. There will be a federal rate cut in the beginning of quarter 3 of 2025. To set expectations, that will probably be a 0.25% rate cut. Does not directly tie to mortgage rates coming down by 0.25%. It's an interbank lending rate that has an impact on overall lending, not necessarily mortgage rates. So I don't foresee interest rates coming back down to like the 5.5% range in this year or the next calendar year. Well, maybe not next calendar year, but for sure this year. And I don't say that to be pessimistic. I say that to say, as home buyers or as professionals working with home buyers, we just have to adjust accordingly. The higher rate environment can absolutely be a challenge, but there are creative solutions out there. What I mentioned earlier, I think buyers should be considering adjustable rate mortgages. I know they have kind of a negative connotation, but truthfully, the average mortgage is held for about 6.5 years. So a 7 or 10 year adjustable mortgage where you're getting a lower interest rate for 7 or 10 years is a pretty safe bet because likely odds are that you'll refinance or sell your house or you won't even see that mortgage through the other side of the adjustment window. So that can be a good option for people who are kind of in that same mindset or who just straight up don't plan on staying in the home for the long term. Um, Another option now to think about is a 2-1 buy down, where the interest rate is lower for the first 2 years. That can give buyers some breathing room just to adjust to the higher payments while they kind of settle into the new home for a little bit. And then also, like one kind of just macro level thing, it's like so unbelievably hard to come up with a down payment right now in today's world where like everything is so expensive. You have a little one, John. I'm sure other people that have little ones. It is tough to go through that on a monthly basis and save money and then come up with money for a down payment. So I think that mortgage options that allow for flexibility when it comes time to like buy into the house with whatever it is, down payment or closing cost are more important to just be aware of than ever. And like just for an example of that, if you can get a down payment assistance in the form of funds or like 15 to $25,000, and yes, those programs do exist. If you think about saving $20,000 at the time of buying your house, you can kind of use that to offset a monthly payment that might be $200 or $300 per month higher than you'd like ideally. So
Mm,
that's the difference in the interest rates now being a little higher is that difference in your payment. Well, if you're saving $20,000, you're still coming out ahead. So when you kind of frame it like that, we'll ultimately do our best to figure out what your budget is, what you can do to get there, and if we can't, what can we do to combat that? Because there definitely are some strategies out there.
sure, sure. And what are you finding? I mean, obviously you have creative solutions, but what are you finding with a typical buyer that might be making mistakes or misconceptions or hearing certain kinds of things, but they're all misconceptions?
Honestly, one of the biggest misconceptions I see is that people think a mortgage is just about like getting approved for a loan and then that's really it. Like in reality, it's about finding the right loan that fits your financial picture, and not all mortgages are the same. Another really, really common myth that I hear is that you need a 20% down payment to buy a home, which cannot be further from the truth. There are plenty of options out there for people with lower down payments, especially programs targeted for first-time home buyers. And I think another misconception is that some buyers think their credit scores have to be perfect to qualify. There are always ways to kind of work with less than perfect credit. I completely understand like how overwhelming the home buying process can be, especially for first timers. I've been there myself, and this is my job, and I still feel like overwhelmed when it's me in the buyer's seat.
Sure, sure.
So my approach, like even with those misconceptions, is to just like break things down step by step. Let's start with a chat about what you're looking for, number one. Then let's get you pre-approved. And then let's figure out the numbers to take all of that pressure off you so that when you are looking at homes, it's just a matter of like, do you like this home or not? Not, okay, now let me circle back and figure out the monthly payment and the mortgage aspect. So with regards to like these misconceptions, so to speak, I'm always trying to educate people on their options, whether that's like down payment assistance or not using down payment assistance or working through credit issues. I think when people feel empowered, they're much less likely to feel overwhelmed, which is ultimately the name of the game.
Yeah, you know what I find? I find because of interest rates obviously hiking up, and ironically, the housing prices have gone up. It's put a huge strain for newer buyers or people just buyers in general, right? And when they get their pre-approval, they're okay with maxing out whatever their pre-approval is because, unfortunately the home has a certain kind of lifestyle that they want to live, right? And that's like the biggest, even for me, like I'm not like obviously I'm not like an accountant or financial advisor to, tell them how or what to do with their money, but common sense is, just because you're approved for $1 million, does that mean that it's okay to buy $1 million house? I don't know, but common sense is, hey, I don't think it's probably a good choice. So, like, where do you stand on that as far as whether it's providing advice or just providing insight on that?
Yeah, I guess your question is like what kind of should buyers be looking for? Or like what should they avoid doing?
Either what should they be avoid doing?
Yeah,
Like how are you consulting a buyer if they're coming in and
I
again,
see. Okay.
you don't have their spreadsheet, their balance sheet to figure out, like the details of their income or whatever or their assets, but you just kind of use common sense and say, man, it's not advisable for you to, get this mortgage or, hey, maybe we should consider doing something else.
Well, yeah, I mean, I think that one thing that I always say, and like this kind of comes back to just my overall mindset of like trying to provide financial guidance as opposed to just like buying a home guidance, is I always say when I'm pre-approving you, especially in the beginning, I will give you a maximum amount that you can be pre-approved for. And then I will give you an amount you should be pre-approved for, because sometimes those numbers can be two different numbers.
Yeah.
And so I think one kind of big mistake that I see a lot of home buyers making now is not getting pre-approved before they go out and see houses. And that's when they run into that issue, John, that you just mentioned, where like you fall in love with a home and the idea of living there, only to realize maybe 6 months down the road that it's way out of their price range, or you didn't get pre-approved and you find out you're not going to qualify for the financing that it's going to take to buy that home.
Right, right.
But you really need to like understand the long-term cost of homeownership. It's easy to get caught up in the monthly payments, but what about repairs and maintenance? There's other things that you have to pay on a monthly basis. So you really do not want to drain the bank account to get the keys to the front door just to
Mm.
like save a few bucks on your monthly payment. So there's a balance, and it's my job to really give guidance on that right balance, even when, hey, it might not be perfect for me, but I think it's better for them in the long run.
So what are the general underwriting guidelines of what the bank will approve versus what you would advise? So what I mean by that is if the
Yeah.
bank will say, hey, we can give you 50% of your debt to income ratio, what would you advise? What are the differences?
So generally speaking, you are able to receive a mortgage for what's called a 50% debt to income ratio.
Right,
That means that if your gross monthly income before you pay any taxes on a monthly basis is $10,000 per month, you can get a mortgage after all of your monthly debts are also factored in of up to $5,000 per month. So think about that for a second. Like if you were making $10,000 a month and your monthly mortgage payment was $5,000, like what are you left over with after your $10,000 after you've paid taxes? Maybe 7,000. And then you've got groceries and now you've got electricity and Comcast or Pico to pay and you've got water bills. So your 7,000 after your 5,000 mortgage payment barely leaves you enough money to buy groceries or for gas in your car. So there's a dynamic. I think it's different, John, like depending on every individual. And I kind of generally look for like a 35% debt to income ratio. I think that's pretty healthy. And the reason why I've kind of landed on that number personally is that after your 70% of your income is paid in, or you get that 70% of your income in your bank after you've paid taxes, 35% of that, about half of that is going towards your mortgage. And
right,
then the
right.
other half is money you can use for whatever else you have to pay on a monthly basis, and ideally have some money left over for savings. So that's kind of normally where I'll steer buyers like, hey, this is a nice sweet spot for a monthly payment, and here's the sales price or the house that will afford you.
Mm, perfect. I mean, that's exactly where I was trying to get to.
Yeah.
The other thing I wanted to talk about was first-time home buyer programs. So I know that we hear it quite often, but then when we get to a lender, it might not actually happen, or they might not actually have them. I think that's what makes your company so unique because you guys actually do offer those types of programs. So if you can just unravel that or unpack that with us on how that works for you guys.
Yeah, that's a great question. So we partner with an agency called PHFA. It's kind of a mouthful, but they stand for Pennsylvania Housing Finance Agency. And there in particular, there are a lot of first-time home buying options available now. You're kind of right that when you actually, when push comes to shove, they're not always available for you. But I've personally aligned myself with PHFA specifically because unlike some of those other programs that are out there, they're a state-run organization and they don't just have a pool of money that they're handing out or promising to hand out, and then that money's gone and you're left kind of out of luck. So, for example, on the flip side of PHFA, the city of Philadelphia a few years ago had an initiative for first-time home buyers. They allotted $10 million that they were going to hand out for first-time buyers on a first come, first served basis. So what happened for a lot of people was they applied for that money, they were approved for that money, and then by the time they actually like needed to utilize that or went to closing, it was all $10 million was done. So I like PHFA just it's a state-run organization through the Federal Housing Authority. That money's never going anywhere. So one of the biggest programs they have available for first-time buyers that I love to use and that we partner with is a program called KFIT, which stands for Keystone Forgiveness in 10 Years Program. Again, the acronym is a bit of a mouthful, but what that program does is provides you down payment assistance up to 5% of your sales price. So if you buy a $400,000 home, you'll receive $20,000 towards your down payment and closing costs. Does not need to be repaid back. It's forgiven over a 10-year window. So every year, 10% of that original loan balance is forgiven. It's fully forgiven after 10 years. If you sell your house in 3 or 5 years, you'll just pay the remaining outstanding balance off like a normal mortgage. But what that will still allow you to do, even if after 5 years you do still owe 10,000, you still got access to that free $20,000 when you bought your house,
Mm,
right? You
mm.
save that money then. And I think more than ever before, that is huge. Having access to that program. Historically speaking, John, you probably remember these days. Like when I first started, you needed a minimum of, I don't know, $20,000 to even have a conversation with the bank about getting pre-qualified or pre-approved, right? Like if you didn't have $20,000 in your bank account, like you could theoretically get a gift if you had access to a gift, but otherwise, like $20,000 was kind of the barrier to entry, so to speak. And nowadays, that's just been completely thrown out of the window because you have access to these first-time buyer programs where you can get into the front door of a home with as little as $1,000. So it's really a game changer in that you're providing access to first-time buyers that otherwise wouldn't have.
That's
So for
awesome.
any people that want to do their own independent research out there, it's called PHFA. KFIT is the name of that program. We partner with them all the time, and it's a really great program, and would love to tell you more about it.
No, that's awesome. That's why, I wanted you to mention it. The other thing that I wanted to briefly touch upon is you mentioned to me that a misconception that most people have is putting 20% down, right? And I think the biggest fear for some people is PMI, right? So can you explain to our audience what that is, what that fear is, and how they can overcome that fear?
Yeah, absolutely. So PMI stands for private mortgage insurance. And that is a monthly installment that you'll pay anytime there is less than 20% down payment made. There are a few ways to tackle that PMI, but most people elect to do what's called monthly mortgage insurance. So each month they pay a percentage of their loan with that PMI until they've reached that equity threshold where they're at that 20% barrier. So if you're putting down 3% as your down payment, for example, you're below 20% equity. So you'll pay that PMI until you get to that point. Historically, PMI existed, for a long time. Historically, though, prior to the 2008 housing market collapse. So I feel like this history is like kind of important now. If you had a pulse, like John, if you had a pulse, you could walk into a bank and get a mortgage. Just anybody, they didn't look at your pay stubs, they didn't look at your bank statements. I'm happy to admit that I was not in this industry when this was going on. But, if you walked into a bank, you could get a mortgage. And so that private mortgage insurance became really risky to these private mortgage insurance companies because people were getting mortgages that shouldn't have these loans, and they become responsible when that person doesn't pay. As a result of that housing market collapse in 2008, lending guidelines for mortgages kind of went on the flip side. So at one point, if they were extremely conservative pre 2008, post 2008, they became really, really kind of the flip side of that. It became more difficult to get a mortgage than it ever had before. They were scrutinizing tax returns, W-2s, things of that nature. And so
Right.
the private mortgage insurance, as a result of lending guidelines being tighter and less people defaulting on their mortgages because they were such scrutinized, the lending guidelines became much more scrutinized. There was a lot less people defaulting on their mortgage. So private mortgage insurance is a fraction what it used to be. Ultimately, the amount you'll pay on a monthly basis depends on your credit scores. But the way that I like to frame it is if you were putting down 10% is kind of an easy magic number. Your private mortgage insurance, depending on your credit scores, will probably range from like $45 to $75 per month. But if you pay that for a few years, let's call it 5 years, 60 payments at $50 per month equals $3,000 in private mortgage insurance. You pay that for 5 years until you're at 20% equity. If that's the difference with the penalty you have to pay to save tens of thousands of dollars in getting to 20% down initially, it's well worth it. So in this market, I think that I'm seeing more and more buyers not have 20% down PMI will always be involved somehow, but the good news is that it's cheaper than it's ever been before, and it's not permanently tied to your mortgage. You can get rid of it. And it's really, again, sometimes 50, 60, $70 per month just to avoid, an extra tens of thousands of down payment. So I think it's really worthwhile and something that people should not be afraid of. It's part of buying a home nowadays.
I think the other thing to consider is even with PMI, with the housing prices increasing, rapidly, is it worth it to, save $50, $60 a month when housing prices are increasing tens of thousands of dollars a year, So,
Yeah, I mean, I have this conversation with buyers, Sean, you wouldn't believe it, but I speak with people that have 20% down,
yeah,
and we actually plan to put 10% down and invest that money in the market because they're earning more on their investments than they would
right,
on the interest they're paying their loan back
right,
plus the PMI. So,
right.
yeah, it is something that really I don't think anybody should be afraid of.
For sure, for sure. Well, we're gonna wrap this up. But for our listeners, Taylor, where can they follow you, reach out to you, or get in contact with you?
Yeah, John, thanks again for having me. People can Google me, Taylor Runyen. You'll find my contact details pretty easily. I'm accessible via text, call, email, Facebook, whatever it is. I always joke I have a little bit of an unhealthy relationship with my laptop, so I'm always happy to have a conversation, whether it's about mortgages, real estate, Eagles, or just to talk about life. So shoot me a message anytime. If you Google Taylor Runyen, you'll be able to find me pretty easily.
All right, cool. I'll just make sure I put all of your information in the description below. And everyone, please go reach out to Taylor if you have any questions in regards to mortgages.
John Lee Real Estate, find you the best rates. All throughout Philly like Schuylkill Expressway. Talking to people who out of the 215, even the 267, who always helping like, oh, no time for no scrutiny.